Hello and welcome to Crux Investor. We caught up with Akiba Leisman earlier today, CEO at Mako Mining. He talks us through their plans for this year, how they're going to finance it, timings on full commercialization of the plant, and maybe some of the numbers associated with that if they get things right. If you want our thoughts and opinions on that conversation, the topics discussed, the company, Akiba, you can find that at cruxinvestor.com/club. We can also find detailed company reports and analysis. We've got commentaries from experts from all over the world on a variety of companies, commodities, and topics. We've got training courses on there. We've got summaries of all the interviews that we've done to save you some time because we know you're busy people. And most importantly of all, we've got a wonderful, thriving community of investors sharing their thoughts and ideas with each other in a nice, friendly, safe environment, free from all that judgment, trolling, and abuse that you see everywhere else. If that excites you, or if you fancy joining that community, go and join them at cruxinvestor.com/club. We'd love your feedback too, so give us a like, leave your comments below. And if you want to see precisely what we talked about today, do take a look in the description below. Akiba, how are you, sir?
Hey, pretty good, Matt. How's it going?
Not too bad. Long time. October. That's how long ago. You've been busy. I've seen you've been busy. I'm excited to sort of catch up and see how things have been progressing. First of all, how are you? How have you been?
I'm doing well. Can't complain.
Got your head down?
Indeed.
Good. Okay. You're no mood to talk, are you? Is this very cryptic?
Yeah. Actually, it was good. I made it back down to Nicaragua for the first time since the pandemic last week. So it's pretty extraordinary, some of the restrictions that we've had to build this mine that we've built over the course of 2020. So it was great to see the mine in operation. The plant is now more or less fully turned on, and then by next week we're going to be in cash flow.
Fantastic. Okay, good. Well, I caught up a little bit with the Selfish, your partner. So I heard a little bit, so I was keen to talk to you. Before we kind of get into it, let's kick off with that 1 minute overview, and I'll pick up with some questions from there. Okay.
Sure. So the way that I always like to describe Mako is that we're doing three things in northern Nicaragua. We have now built what is the highest grade open pit mine in the world, bar none. But we initially scoped this out at a 500 ton per day capacity. The plant is now commissioned. All circuits are operational. And then by next week, we're going to be pouring commercial gold, sending out shipments. And then over the course of the next few weeks, we'll be ramping up to kind of that steady state production of about 500 tons per day at the plant. We're already there over at the mine. Now, secondarily, we've made a discovery a couple of kilometers to the south of San Albino, an area called Las Conchitas. And that 500 ton per day plant, we made decisions to make the civil works associated with it with minor adjustments to get it up to 1,000 tons a day. The objective is to bring Las Conchitas into the fold by proving out a maiden resource on that early next year, and then to start mining this at 1,000 tons a day by very late 2022. And then probably the most important thing about the company is that we do think that we're sitting on an orogenic gold mining camp over here. So over the course of the next days and weeks, we're going to be putting out initial prospecting results elsewhere in a 188 square kilometer land package that does show that this has the potential to be an order or maybe even 2 orders of magnitude bigger than what we have delineated right now just at the San Albino 500 ton per day area.
Cool. Okay. Lots to unpack there, which is great. I want to go back a bit. Our last conversation, I think you had I thought it was a very honest conversation about, your plans, what was going on in your head, not what you'd walked into, and about how you tackled this. But I think the market was still either reluctant to believe or waiting for you to deliver. So do you think you have been delivering?
Oh, no question about it, right? So the management changes of this company occurred at the tail end of 2019. And from that moment in time, we laid out the strategy. We are building a mine. We had our permits in place. And with the infusion of capital that we took in 2019 and 2020, we've now delivered it. We've been mining the high grade sporadically since the end of last year, and now in relatively commercial fashion from the mine. There's always been a lot of key risks associated about mining this deposit, inclusive of risks that I perceive. And when we put out that resource last year, there were really two motivations behind that. The resource that our predecessor had was not a good reflection of the reality of the geology in the deposit. I actually don't think there was much funny business going on. There's plenty of funny business resources out there in the market, but there were certain choices that they made in developing that resource that didn't adequately or accurately portray geology as it existed in real life. So the resource that we put out in October, which actually kind of bifurcated the market, there were people like say, whoa, that's a small resource. Oh my God, what's going on over here? Then there were people that actually understood what went into that resource and who we used to put that out, and some of the decisions and some of the thought processes and some of the conservative assumptions that we put into it. But we mentioned in that resource is that this is going to be conservative in terms of how we calculated the resource in terms of numbers, and more importantly, in terms of how we are going about mining it. So we actually put out last week a press release about mine reconciliation to date. We are positively reconciling on grade by over 20% to the resource that we put out. On ounces, a little over 6%, which is completely not a surprise. In terms of the assumptions that went into the resource, we are mining at tighter tolerances than the assumptions that went into the mining side of the calculation of that diluted resource of 9.56 grams. And mining to date within that vein, we are pulling out diluted material in excess of a half ounce, 17.5 grams gold in an open pit, right? So the purpose of that resource was just to make sure that we actually have the bones of credibility, that we know how to plan internally to build a mine, and then in the communication to the market to make sure that when we put out technical information, we're going to be meeting or exceeding it. Full stop. We do not have tolerances for underperforming or negative reconciling to any of the data that we put out there into the public sphere.
I thought that resource was one of the smartest things you did last year, because it kind of reset everything for you, the kind of the new version of the company. So I really like that. Let's talk about some of the issues that you were trying to solve, because we talked when we first spoke, and the last interview we talked about dilution, how you guys were going to try and not just report it but control it. And optimize your processes. So just talk about some of the things you've learned since October about how to go about it.
Sure. I was out in Nicaragua last week, and our mining contractor, who's a local person from the town, who's now I think probably one of the wealthiest people in El Higro at this point for mining with us. So we had a barbecue last week, and I mentioned to him is because I don't think he fully realizes just how unique how we're mining this open pit is. It really, I don't believe another mine is kind of mining the open pit the way that we're doing. So to put this in perspective, the San Albino vein is relatively narrow. It's about 1.25 meters on average, and on average is always kind of a dangerous way to describe geology. Sometimes it's skinnier and sometimes it's thicker, but that vein, by and large, is grading, let's say on average, about 17 grams a ton throughout the life of mine. Now, when we calculated that resource, we diluted that by making an assumption that we were going to be mining with mining tolerances about 50 centimeters on either side of that vein. And then through pretty fancy calculations, that 17 grams got diluted down to 9.56 from a measured and indicated category in that resource that we put out in October. We are mining at sub 30 centimeter tolerances right now. And the way that we're doing it is that we have 6 meter mining benches, but we mine half a bench at a time. So now you have 3 meter mining benches. And then that vein, which is 1.25 meters wide, we happen to be in a particularly high grade, but a particularly skinny part of the deposit right now. So the average vein that we're mining right now is only about 3/4 of a meter wide. That 3 meter half bench is on average about 4 times the size of the vein itself, right? So if you're going to be mining this in a conventional fashion by taking out that 3 meters at a time, you're going to be diluting your numbers by a factor of 4. That is not how we're mining it. We have that 3/4 of a meter vein. We have extremely sophisticated and detailed grade control programs on how we're analyzing the grade within that vein in situ. We have very, very skilled geologists who can actually distinguish between the vein, the hanging wall, footwall, country rock. We do scope it out. We scrape away the waste, and then we try to take only the vein. And this is another thing that we do get kind of criticisms from the outside about our mine about strip ratio, right? So yeah, there's waste that goes with a mine. Life of mine, we're probably going to be somewhere in the neighborhood of 23 to 25 to 1 from a strip ratio, and mine to date we're about 19. But this is the issue with strip ratio. we are intentionally targeting a high strip ratio by selectively mining this in the open pit, simply because we're not mining this conventionally. We're trying to take as little ore, quote unquote, ore as possible, and try to remove as much waste as possible. So sometimes when you're looking at key performance indicators of strip ratio, it really doesn't tell the story of what we're actually doing. The most important thing to us when it comes to mining costs, it really is the dollar cost to get an ounce of gold out of the ground. And even in our strip ratio with grades like this, at 17.5 grams, our mining costs per ounce on material like that is around $100 an ounce. It really is a small amount of capital to go and move that type of valuable dirt. But
people aren't getting it at the moment, are they? I mean, okay, you guys have been moving sideways since the last sweep, which is fine compared to the market, which I think most gold charts are negative. So that's a win, I guess. But you still got to be, and look, in your 260 million market cap, I guess you're going to hope for a production re-rate at some point too. But it's not. People haven't got it yet, it feels like to me. They haven't got what you're trying to do. Have you done things in the right order? I mean, why go and build the plant now?
Yeah, look, there's always going to be people that disagree with the strategy, and some of those criticisms are sensible. And I want to be clear about this, is that what we do on any day and any decision, there's a trade-off in terms of what we do. There is going to be less technical risk in terms of how we were going to develop this asset if we spent 5, 7, 10 years drilling the ore body out and kind of having a long-term plan like that. Yes, I fully acknowledge that there's a less technical risk by going through the project that way. There would not be less actual risk by doing that, by putting in 60, 70, $100 million of de-risking this and spending the 7 to 10 years that are required to do the overall, call it regional plan of getting this up and running at the final size of 1,000 tons a day with, let's say, a 10-year mine life associated with it. The amount of money, the capital and time that it took meant that is a more risky financial decision for us to take. So like it or hate it, it was a decision that was made, not because we're crazy. It was a decision that we made because we do have a natural bias towards the investment side of the equation. And we try to mitigate the risks as much as possible, even though the decisions that we took to build this plant in 2019 were more accelerated than I would consider to be normal course in our industry.
So what does that mean? What are the either ends of that scale? I mean, you've got a bias or a leaning towards the investment side of the story. So what were the factors which drove you there? I get your background bit, but what are the numbers behind that?
Yeah, it actually a lot had to do with the deposit, right? So this is one where the geology is unique. This is not a model which exists in many other deposits around the world. We have narrow veins that are shallow dipping. We were going to be mining this from an open pit. We have a variety of different types of veins throughout the deposit. Not everything is apparent in terms of what's going on in the core. I think we all made a decision that we were going to get a lot more comfortable with how the geology was going to lie once the pit started to get opened up, right? So a lot of it was driven both in terms of us wanting to find out what this thing looked like. So I actually usually don't like doing bootstrapped approaches to investments. I really do think you kind of want to right size things initially. This happens to be a project that is very well suited to bootstrapping. Simply because you can actually understand what's going on in a small area of the mine and then duplicate this elsewhere on the property for similar types of open pits. And then the plant itself with minor adjustments can be expanded when the time is right to do that. On top of that, we actually made some social commitments to the community, to Nicaragua. I only took over as full-time CEO of this company in August of 2019. The permits were received to go and and mine this project in 2017, I think. So for a while, everybody was kind of twiddling their thumbs, like, where's the mine? what's going on here? And then there's going to be a practical amount of time that you can actually keep a permit in place like that and maintain your social license, whether it be with the government or more importantly with the or as importantly with the local community in the area. There were expectations that this was going to be an industry for this particular part of Nueva Segovia.
Why did some of your shareholders think or talk about dividends, share buybacks, etc.? You're not making money yet. You're not commercial yet. Why is that? Why is that narrative out there?
Right, exactly. I actually sometimes get into the same conversation with our larger shareholder, which I used to work for as well. I think the end of the day is that we have three things that we need to do. We've now built the 500 ton per day highest grade open pit mine in the world. We do need to get additional resources outside of the main San Albino area in order for us to practically and sustainably be mining this at 1,000 tons a day, which is going to require at a minimum $8.5 million a year in exploration expenses for at least the next 2 or 3 years, and then to start proving things out regionally, which in the early years are not going to be a lot of dollars, simply because we're not really ready for real robust drill programs regionally. We'll do some initial work on that this summer, and then over time that will expand as well. At least in the initial mine plan, we're going to be making a lot more money than what's required to service our debt, and then to spend that $8.5 million. We don't believe in war chests. So once we actually spend everything that requires to do our three main objectives, we have no issues with shareholder returns. But you're right. This is an operating company that is now at step 1 of 3 right now, and it's really only after step 3, and frankly step 3 plus debt repayment. So even those 4 steps that we can actually legitimately start talking about shareholder returns.
Yeah, absolutely. The other thing they're talking about, rollback. Is that part of the plan?
Yeah, the purpose of the rollback is that Mako is a liquid stock. I like to say we're 10 times more liquid than we were before I took over, and we're still FL in terms of liquidity, right? So in terms of the generalist community, in terms of being attracted to a name like Mako, it really is a large hurdle for a lot of institutions to get over. If we trade just a couple $100,000, $300,000, $400,000 a day, that is not a liquid company. There are many paths for us to move to enhance liquidity. It can involve M&A. It can involve just getting bigger in general. It can involve executing on your plans and talking on interviews like this. But you can do incremental technical things like try to check all the boxes to be included in an index. One of the preconditions for there, at least in my mind, is a migration to a bigger exchange, the TSX Venture Exchange. So when we announced a rollback last year, it was really going to be conditional on the TSX accepting an uplisting to us. We got involved in some Kafka-esque discussions with the exchange about what is required from us in order to be elevated to the TSX. So I do think this is going to be delayed until next year. But the decision behind the rollback was sensible. It had nothing to do with having a pretty share price or whatever, or trying to somehow mess around with retail shareholders. It really was there as a stepping stone to get to an exchange that enhanced liquidity in order to check one of the 8 boxes that we needed to get index inclusion. And even though I wanted this to happen this year, we do need to have that mine operational for at least 6 months before the TSX will allow a migration.
Okay, let's come back to the money side of things. Okay, so the plant, at the moment you're sort of tinkering around and trying to optimize stuff with the plant. So how much more time, how much more money is going to be allocated to that?
Yeah, so it is a time issue, right? So the mine is if anything ahead of schedule. We've been mining over 500 tons per day for at least the last 6 weeks of diluted vein material and the historical dumps. And then we have enough, about 4.5 months stockpile at this point. So by the time that we get into the meat of the deposit in July, we'll have all the running room that we need to feed the mill. The plant, there's nothing major at issue with this, but it's one of those subtle things. There were some overt things that happened with the pandemic, right? So it was last March where it was prior to the pandemic hitting Nicaragua and Managua specifically. I was in New York. It was really starting to deteriorate over there, and I was telling the guys that this is coming to Nicaragua at some point, and if we're not comfortable operating safely, we have to make some adjustments. So we did down throttle our exploration spend in March of last year. We had an initial retrenchment in our personnel from mid 400s to mid 200s. It's now back to where it was before. So we had to make some overt adjustments because of what was going on for the global pandemic, and then we also got hit by a couple of hurricanes during that period of time as well. Luckily, there really wasn't any material damage to the property. But there are also some subtle aspects of the pandemic where we knew about, but we didn't really know about. So normally when you're dealing with some of these debottlenecking exercises, especially when you're dealing with pieces of vendor equipment, you actually have a vendor on site kind of hand-holding you to go through some of the tweaking that needs to happen. And it would take us 6 weeks to get a company rep from our filter press or Acacia refinery on site. And then they would leave, and to get them back would be another 6 weeks. So a lot of these things kind of built up on itself. None of them were CapEx related. It was just trying to get these things operational. So the plant is probably about 5 weeks, 6 weeks behind where I wanted to be today. But fortunately, yesterday we started to apply cyanide to the CIL. That is a big thing, because right now we probably have about half of our gold being recovered through gravity, which also has some tweaking that needs to happen. And then with the supplement of the CIL, as soon as that gold starts getting stripped from carbon, which we expect to happen tomorrow. So this is Thursday this week, and then by early next week we're going to be shipping gold, and we'll be profitable really from day one on when those gold shipments occur. Probably still take at least a couple weeks for us to get that mill up and running to a steady state of 500 tons per day. But the most important thing is that the company will be self-financing really as early next week.
What does profitable mean?
I'm talking about like the ability to generate cash. I actually haven't. By the way, I think Q1 for just because of a lot of movements on our balance sheet will actually be a pretty profitable quarter. But I'm a cash guy, so I'm talking about cash flow positive. Okay,
because you've got a credit facility in place with Nebari, which you put in. What was that, about just over 6? Was it?
Yep.
Why?
So we took two forms of financing last year to basically finish off the mine. There was a $15.15 million facility to the controlling shareholder, Wexford, which we set at the time, and this was actually pre-pandemic. This was February of 2020, to get us to basically first gold pour. It actually wasn't going to be a sufficient amount of capital to commercialize the mine. We did experience actually quite a bit of delays because of the pandemic associated with that. And then we did our $20 million equity raise in August of last year, which was going to be sufficient to get us to a first gold pour in January, and then commercial production probably from about 4 or 5 weeks before today. So there were obviously things that were pushed back because of the hurricanes. Our cash balance got way too light for our comfort, and then we took US $6 million cash. It was notionally $6.35 million from Nebari, which was going to be sufficient to get us through to commercial production, even with some additional delays. So as of this morning, we still have cash on the balance sheet from that facility, and then next week that cash balance, instead of going this way, will be going this way. So we'll be fine.
Right. As you say, the next 3 years, it's about reinvesting most of the money that you're creating, this cash flow that you're creating, back into the company, back into the project, because this isn't about the plant. It isn't about the open pit. It's about Los Conchitas, and building this up into a camp, isn't it? So that's going to take money. So you do want to hoard money. You don't necessarily want to dish it out to shareholders. I don't think they necessarily want to throw it back at them. You've got to build something here, haven't you?
Sure, I do think that the debt repayment is on the cards right now. These I actually like both facilities. I think that the Wexford facility was fair. I think the Nebari facility was fair, but in the context of large mining companies or even mid-sized corporates around the world, it happens to be relatively expensive facilities. If you added all the bells and whistles, you're talking about a low teen type return. So there's really no reason for us to keep debt facilities like that on the balance sheet. There's also a practical limitation for what we can do on the exploration side. There are truly hundreds and hundreds of targets that are viable and will meet geological thresholds for us to commit to a drill program. But we are limited in terms of personnel, geologists. We're limited in terms of rigs, limited in terms of capacity to house drillers and support staff outside of our operations, and then limited in terms of, probably most importantly, limited in terms of the speed that we can actually analyze the data in a useful fashion. So I really don't think we can, even if we wanted to, spend more than $9 or $10 million a year. So there's plenty of, if we were unconstrained, the targets that we have available would attract capital more than that. But there is a limitation to how much we can spend. And when you're dealing with grades like this, and our production profile, even at that 500 ton per day level, the amount of cash flow coming from this mine is going to far exceed what we can spend on the reinvestment side, that a lot of the excess cash will be used initially to debt repayment. Okay,
so give us a sense of that. What's your expectations?
Yeah, so I mean, it's always kind of dangerous to talk about averages with our mine. Like, this is not, by the way, we mined to date 17.5 grams of diluted vein material. This is not a 17.5 gram deposit. I do think this is higher than 9.56 grams that we delineated in the resource. Even the 17.5 grams was positively reconciling to 14.5. It wasn't positively reconciling to 9.56. So we happen to be in a particularly high grade part of the mine. But at 17.5 grams, we're going to be recovering that gold at something underneath $400 an ounce. And I would say life of mine, this is going to be all in probably $700 an ounce. So even at the 500 ton per day scenario, where you're going to be a mid to high 40,000 ounce a year producer net of recovered gold, this is still going to be generating at these gold prices in the upper half of $40 million in cash flow. And even for this stub year, because we'll have, let's say, 6.5, maybe 6.75 months of maybe 7 months of nearly full production. Even in that 7 months, we should be making more than $30 million for this year.
So what are your options with that? I know we've talked about, okay, you can do dividends, you can do cash buybacks like you do at Sailfish, but what realistically in this market, okay, there's going to be like the big guys are, basically shoring up their balance sheets. There's going to be M&A activity. You're a single asset, single jurisdiction risk, all of that kind of good stuff. Let's say it all goes swimmingly and you do generate that sort of free cash flow from your operations, and you are limited to the extent that you can invest in your current assets or camp. What do you do?
Like I said, we don't believe in war chests. I do think 2020 is kind of shaken the confidence of what a war chest actually means. So I would say, if you ask me this question in terms of in 2019, I would say this is the amount of cash that you kind of want to keep on your balance sheet. After 2020, it's this, right? So we kind of have to, which by the way happens to be substantially more cash than we have this morning, because our cash is frankly too low than it should be. Once we actually maintain a certain level of prudent cash on the balance sheet, there really is no reason for us to keep it if once the debt is repaid. And even if there are external opportunities, we do have for lack of a better word, a disciplined approach to looking at external opportunities. If there's an external opportunity and it's attractive, it should be financeable if it requires capital. And if it's not financeable, maybe it's not attractive, right? So it's a good check on management's appetite to always want to do something more by trying to keep your balance sheet as efficient as possible.
Is that your thinking, or is that your major shareholders' thinking? I mean, what's driving that?
So I've been trained by the major shareholder. Indoctrinated is probably a more accurate word, for over a decade. So we are aligned in that regard, and I do think it's probably a good rule of thumb to think that way. Because really, in capital intensive industries, cash does burn a hole in your pocket, and I think everybody is susceptible to it. So it's always good to take a step back and say there are sensible opportunities. This company, and I've mentioned this before, is that even if we're able to execute on all three of our plans, I do think that we're actually too small to be an ideal structure in this market. So I really have no issues to do incremental or even transformative M&A. This is really the first, later this year is probably gonna be the first time that we can actually take a breath and think about it. For the last 2 years, we really were trying to build this mine. So I have no issues with that. But those are decisions that need to be made outside of the fact that you just happen to have X number of $1 million burning a hole in your pocket.
But does that make you attractive as an acquisition? Or not? Because you've talked about a very specific and very precise and unique situation that you've got, not in terms of the ore in the ground, the deposit, but also the way that you've had to go about mining it. Or is that actually, is that a problem for you? You are going to have to go it alone.
That's a fair criticism, right? So the last time a mid-tier major even took a cursory look at our data was it's probably right before I took over as full-time CEO. It's probably right around that time. So we'll call it the back half of 2019. We showed them what we were going to be doing and said, this is our ore body. We were probably 90% done with our geological models. So the data that exists in the public domain today is probably was about 90% as good back then. So they weren't even relying on some of the specious information that our predecessors put out to the public market. And we told them, this is how we're going to be mining that. And they basically said, BS, you're going to be diluting this to 4 or 5 grams. And we're like, no, this is what we're going to do. Like, here's a picture, here's a cartoon, what we're going to do. And they didn't believe it, which is fine. And it meant that we needed to really go alone. The interesting part about that anecdote, it just shows you kind of how mid-tiers think. They actually did not want anything to do with the mine, but they were actually very interested in the exploration ground. And I'm like, it's the same thing, right? What we have on the exploration ground is the same thing in the mine. What you're going to find there is the same thing over here. If you're not interested in the mine, why would you be interested? So it's kind of a weird way of thinking in terms of how corporates were behaving in 2019. Now, the geology and more importantly, the geometry, kind of how our ore body lies, it's always going to be difficult for us to delineate a large resource, just because the amount of surface area that we need to drill in order to, and also the fact that our veins are relatively narrow. Some veins are more consistent and persistent than others. So there are limitations in terms of how we can string together resources in a credible fashion. So we're always going to be kind of on the hamster wheel of trying to get to a large delineated resource. And there's a lot of companies out there in the world that when they're doing M&A, the prime objective is to bank reserves, and we're just not the type of company to do that. That being said, I do want to move Mako into the position where it's liquid, where it is saleable if we ever choose to do that. There's things that we can do on the execution side over the course of the next few years. There may be incremental M&A that we can take that's would be, let's say, more conventional in terms of how ore bodies are viewed to help move in that direction. But I in terms of criticisms of Mako, valid and not valid, that is actually a valid criticism, is that because we have limitations on how big our delineated resource can be, it is going to be difficult, not impossible, difficult for a larger company to say, aha, I know what these guys are going to have in the long run. So let me make an attractive X% premium acquisition of them.
Hey, do you fancy making a rod for your own back? Because so far I've heard you've done what you've said. You said what you've done. What are the numbers we should be looking out for this year from you? See if you hit them.
Yeah. So, like I said, it's always dangerous to talk about averages, and so investors should not take that 17.5 grams and then move forward. I'm operating under the assumption that all of the gremlins are going to be outside of the plant by mid-May of this month. And if that's the case, we will be mining, so that there will still be a substantial amount of stockpile. We'll be mining close to 50,000 ounces for this calendar year. And then from a production standpoint, it'll probably be in the low 30s, thereabouts. But even with that low 30s, you're going to be in a situation where like EBITDA for this year will be in excess of 30 million.
Okay. That's the number we should be looking at, and mid-May. Excellent. You may regret that. Hey, Akiba, I appreciate your time today. That's a nice catch up. I like how you're piecing it together. I like, it's realistic. It seems like you've kind of got a dose of finance guy learns that operating's not that smooth. I mean, it's not just all COVID. Mining's tough, right?
It is. It's a tough business. There's a lot of risks from the operational level to the social level to most businesses are like this to the people level, right? So to your team and things of the sort. So this is not. If there's one criticism for some of my investor former compatriots is that we do fall victim to spreadsheet analysis, right? So check the box type deals, and we were equally guilty. This is not a criticism that I'm not making to myself when I was an investor. And then when people take a look at whether it's track records, whether it's the ability to get mines up and running about whether a resource is going to work or not, it is amazing how many shortcuts investors need to take in order to make their investment decision. Principally because investors just feel like having data makes them more comfortable in the decision process that they're making. In reality, having incremental data is sometimes worse than having no data, right? And I do think we fall victim to that in the investment community about that. Very similar to what happened with our predecessors. They put out a 900,000 ounce resource. Said, wow, 900,000 ounce resource, that's high grade. Yes, it's a PEA, so we understand that there's risks associated with it. That data point that was out there in the market did this company a disservice, right? Just because it anchored people's expectations and it wasn't reflective of reality because of various technical choices that were put into that resource. And investors were making a decision based on this report. But if they actually took time to go through the data, they would have recognized exactly what this deposit was about. And it made us more attractive to this investment opportunity the more that we knew about it.
Yeah, it's interesting. It's interesting. Do you think that you still, that kind of historic expectation setting, which happened previous management team, do you think that you've still got a little bit of backfilling to do? Let's face it, if you're talking about 50,000 ounces, 260 million market cap company, that's kind of up there, isn't it?
Oh, I've said this from 2019. I've got like 3 circles on my presentation on my Twitter feed. I got like the 3 objectives: 500 tons, 1,000 tons, orogenic gold mining camp. 1, 2, 3. From the beginning, I thought one was 20 to 30 cents on the dollar, right? Now, I think people can have realistic debates as to what a dollar means. Is a dollar $2 a share? Is a dollar $1 a share? Great, we can get into that discussion. But San Albino proper, if you take time to understand what we have, really is only about a quarter of what I actually think the value of this company is. Yes, it requires execution on our end to go and prove out more resources to get this up to a material scale, because you're correct, a 45 to 50,000 ounce a year producer is too small to be a public company, but that's really not our intent. Our intent is by full calendar year 2023 to be, let's call it 70, 80% more than that. Likewise, we do need to prove some sort of at least potential for longevity. I don't think we're ever going to have like a long mine life here. Like the investors should not expect us to have a 10-year mine life on this asset ever. But we should have enough information to say, if we do this, this, and this, and this on the exploration side, yes, I can take my 3, 4, 5 year mine life and then turn it into 10 over time, because there is the data to support that with some technical work that needs to be supplemented on there. So yeah, so for people that think we have a hefty valuation on objective number one, okay, but that's not Mako, right? If you're investing in Mako because of the mine, like, what can I say? It's like we have 2 other objectives that we need to do, and if we execute on it, great. We'll re-rate to that level. If we don't execute on that, that's okay too. Like or I shouldn't say that's okay, but from an investor's perspective, they can make that investment decision saying they were not able to execute on 2 objectives that were worth 75% of the company's value, and now I have to reevaluate my investment decision.
Brilliant. Akiba, appreciate your time today. Stay in touch, okay?
Okay, all right, take care, man.